Chapters 14 and 15 deal with money in the banking system and the Federal Reserve and monetary policy. So I'm going to combine these together, chapters 14 and 15, to talk about money and monetary policy. Again, we oftentimes think of money as a medium of exchange, which obviously it is. But money for our purposes has multiple meanings. Money is extremely important. Obviously, money serves as a medium of exchange in society, but it also must serve as a unit of account as well as a store of value. Um, Again, initially, if you go back in different cultures, a monetary system was typically a barter system where with the direct exchange of goods and services. But a barter system doesn't tend to promote economic growth or employment very well, and it's oftentimes difficult to have direct trade because of the coincidence of wants problem. So most societies have developed a form of a monetary system, which effectively is a form of a barter system where you simply barter um, uh, goods for money and then barter money for goods and so forth. Um, okay, so that's just a little bit on money. Um, there are also some key properties to money. Money must be, in a sense, portable, uniform, divisible, um, and money must also be scarce to hold some degree of value. Um, there's nothing particularly special about green paper. We just happen to use green paper as our monetary system, as one type of money in our monetary system. Um, The government, though, classifies money in different ways, and we weren't very creative with these titles, but we can talk about the M1 money supply, the M2 money supply, and there's even higher level money supplies, M3 money supply called L, and so forth. But the M1 money supply is basically all currency, and this is on page 336, all currency outstanding plus checking deposits, any type of demand deposit, and traveler's checks. And as of 2012, the M1 money supply in the United States was about $2.4 trillion. Once you add into that the M2 money supply, you effectively add in all saving accounts, which are known as near monies. These monies can be gotten, but they're somewhat a little bit more difficult to get, and there may be penalties to pay for getting those monies. The book basically talks through how banks go about creating money, and we know banks create money in the monetary system not by printing money, but by simply making loans. So a bank's deposit dictates how many loans they can loan out based on the money multiplier process. Well, the Federal Reserve sets what's called the reserve requirement ratio, which then on page 342 we can see the simple money multiplier is 1 divided by that ratio. So for example, it says there if the required reserve ratio was 10%, then the money multiplier would be 10. If it was 20%, it'd be 5. If it was 5%, it'd be 20. And that helps us dictate then how many loans can be outstanding as well. So the primary purpose of banks is not only to hold our money, but also to make loans and be an important integral piece of the monetary system. Now, when you move on to chapter 15, it talks more about the role of the Federal Reserve in monetary policy. Local banks are only a small piece of the overall monetary system. The Federal Reserve, or sometimes referred to as the Fed, is the central bank of the United States and is extremely important as it supervises and regulates all financial banking institutions within the United States. The Federal Reserve was actually enacted in a act of Congress back in 1913 and goes into effect in 1914. So the Federal Reserve is 100 years old this year. If you do a little research on banking history, and you may have gotten some of this in some of your history classes, the first Bank of the United States was formed in 1791, put on a 20-year charter, dissolves in 1811. We have a 5-year hiatus with no central bank. The second Bank of the United States is created in 1816, again on a 20-year charter, dissolves in 1836, and the United States has no central bank from 1836 all the way up until 1913. when we created the Federal Reserve System, and it effectively is our third central bank of the United States. But it was not put on a 20-year charter. It was put on a permanent charter. It has quasi-governmental power. The chair of the Fed does have a responsibility to go before Congress quarterly, answer questions, talk about the state of the economy, but Congress and the President has no authority over the Federal Reserve chair or any of its members, and cannot force them to do anything. Likewise, Congress has no perennial power over the Federal Reserve, its members, or its chair. They can only ask questions about monetary policy, why they did certain things, why they didn't do certain things, and check on the state of the economy. The makeup of the Federal Reserve is somewhat interesting. It consists of 12 district banks, and if you look on page 352, it shows you those districts that are listed out. And in fact, I don't think I have. No, I don't. I apologize. But if you pull out a dollar bill and you look at a dollar bill, every dollar bill says there's a letter on the dollar bill inside the circle, and those letters will go from A to F. Those letters correspond into numbers: A's 1, B's 2, C's 3, and so forth. Well, if, for example, the letter on your, let's say the letter on your dollar bill is a D, well, then obviously D is the fourth letter, so that means that's the fourth district bank. And if you look there on the figure 15.1 in the textbook, that's the Federal Reserve District Bank of Cleveland. And if you read around the D on your dollar bill, it says Federal Reserve Bank of Cleveland. And then there's actually then $12 bills in circulation. A will say Boston, B will say New York, C will say Philadelphia, D will say Cleveland, and so forth, all the way up to L, which has printed on the dollar bill San Francisco. Now, once you get into the 5s, the 10s, the 20s, the 50s, the 100s, they used to have individual district banks printed on them, just like the dollar bill currently does, but they no longer do. Now you'll be able to see printed on your 10s, 20s, 50s, and so forth. It'll just say A1, B2, C3, D4, and that refers it back to the district bank, Federal Reserve Bank, that issued out that currency. But the Fed doesn't print currency. The Treasury Department prints the currency. The Federal Reserve issues out the currency. Back to the structure of the Fed, we have 12 district banks, all with a president. You have a board of governors consisting of 7 members appointed by the president, confirmed by the Senate. And then within that board of governors, the president of the United States gets to choose a chair of the Fed, which also is confirmed by the Senate. And they serve 4-year terms, all within a larger 14-year term for board governors. The current Fed chair is actually the first female Fed chair in our history, and her name is Janet Yellen. She is a PhD economist and an expert on monetary policy. Within the Fed, then, you have what's known as it's listed there on 351, the Federal Open Market Committee. And the Federal Open Market Committee consists of 12 members, the 7 members of the Board of Governors, plus the New York District Fed President, and then 4 other members of the presidents of the banks, of the district banks, serve on a rotating basis. That gets you to 12 members. Those individuals meet about 10 times a year, and they conduct monetary policy. So those 12 members meet. They talk about the state of the economy. The other members are non-voting members as well, the other presidents. They get together, they meet, and they simply decide whether the Federal Reserve wants to either lower, raise, or keep interest rates the same in the country, which then has an impact on the money supply. Monetary policy, then, which is dictated by the Federal Reserve, conducts monetary policy in a few different ways. They can lower the discount rate and the federal funds rate, which are interest rates within the economy used by the Federal Reserve. More often, they use what's called open market operations, which is the buying and or selling of government securities to move the money supply, control interest rates, and therefore push the economy in certain directions. And on page 359, they talk there about the ways typically the Federal Reserve goes about fighting problems in the economy. If we're in a recession, we typically want easy money, so the Fed's going to buy securities and push interest rates down. If we have inflation, the Fed typically wants tight monetary policy, and they sell securities to the public and raise rates. Today, we have some of the lowest interest rates in our history, which is a signal then that in the recent past, the economy has been extremely weak and monetary policy has been pushed to flood the economy with money, keep interest rates low, to try to stimulate more investment. As you see in the near future, interest rates we expect will slowly begin moving upward, which is a sure sign that the economy is in fact gaining strength and getting stronger as those rates move upward. A couple of good pages on the recession, Great Recession back in 07, 08, and 09, and some good discussion there about monetary policy disadvantages. The rules discretion debate has been going on for decades, whether the Federal Reserve simply needs to respond to events as they occur, or whether they need a set rule in place to conduct monetary policy essentially the same based on one set rule instead of discretion. Also, the independence question is often a good one. The Federal Reserve is, in fact, as I said, a quasi-governmental agency. The Federal Reserve Chair is oftentimes referred to as the second most powerful person in the world behind the U.S. President. They have a lot of discretion with the way they conduct monetary policy. No cameras, no reporters, only abbreviated minutes of their meetings. They do internal audits. So the Federal Reserve has a tremendous amount of power, and in recent years there's been more and more questions asked, both from the public and from members of Congress, about the openness of the Fed and whether they should in fact be more open to the public. But again, the private nature is done to try to keep monetary policy out of the political arena, out of the media circus, and try to have serious discussions about the good of the country, not the good of any politician or party, and not give way to the sensationalist media. We don't want to make Fed members into rock stars, essentially. We want serious, solemn individuals that are conducting these policies based on the best academic information, the best data available, and to do simply what's in the best interest of the country, not any one individual or group of individuals. So again, the Fed and monetary policy is also critical to understanding macroeconomics, and these are two really good chapters. If you have any concerns or questions, please let me know. Thanks.